There's more to Europe's sovereign debt woes than just Greece. Other countries have to issue debt too. We partner with the Financial Times to bring you Lex on Bloomberg so you can get a sneak peek at the FT's flagship column a day early. Sarah O'Connor joins us now live from London. Sarah, they call it rollover risk. Why do we care so much about it?
Well, we're caring more and more about it, actually. Particularly the rating agencies are taking a look, investors a bit more. It's just a measure of how often countries need to tap capital markets to refinance their existing debt. And with debt on the rise in all countries, as you say, it's not just Greece that needs to keep going back to capital markets. It's a measure that's worth taking a closer look at right now.
It certainly is. Now, it may seem obvious to some people, but it isn't. Explain why rollover risk has increased for other countries that aren't in Greece's fiscal situation.
Sure. Well, part of it is simply that all countries have borrowed more and need to keep borrowing more to fund these fiscal deficits. But also there's a more detailed reason, which is that short-term debt is on the rise. Countries have been issuing much more short-term debt. In fact, as a percentage of total debt in Europe, it's almost doubled to about 11% now. The reason they've done that is quite simple. The yield curve is now so steep that actually borrowing at that short end is really very cheap. If you're a kind of highly rated borrower, it's almost like free money. So it's been a tempting thing to do. It keeps interest rates lower. But there is this added danger then that you have to keep returning to capital markets more often.
Right. The more short-term debt you issue, the more frequently you have to come back to the debt markets and raise more. Tell us, though, when you look across the Eurozone, which countries are most at risk when it comes to rollovers?
Well, it's not actually the usual suspects. It's not the ones you would think. Take the UK, which obviously has pretty parlous fiscal position right now. Actually, its rollover risk is pretty low, and that's because traditionally it's always issued very long-term debt, and it hasn't really changed that. So it needs to refinance about 5% of GDP this year. Then you look at Greece, that's kind of middle of the class, about 13%. The same for Spain. The ones that really do have high rollover ratios are Italy, Ireland and Belgium. So perhaps not what you would expect. But with Ireland, maybe that explains a little bit why they've been so determined to present a very credible austerity package to the markets.
Now, Sarah, you did explain, though, that the yield curve remains very steep. So if they do have to come back to the public markets, it is possible, though, that you could still keep your borrowing costs reasonably low relative to, say, longer-term debt if you issued bonds on the shorter end of the curve, no?
That's true, yeah. If you keep doing that short-term thing, then that's fine. The danger, of course, is that at some point, interest rates won't stay this low forever, and particularly with quantitative easing presumably on the way out, at some point interest rates will rise, and then those ones that need to refinance more are at a greater interest rate risk as well.
All right, so you keep issuing short-term debt, seems fine, then all of a sudden one day you got a problem like Bear Stearns or Lehman Brothers. Sarah O'Connor at the Lex desk in London, thanks very much.